Understanding exactly where Bitcoin is operating and how it's directed, the picture that you're looking at are the nodes on the Bitcoin network. And there are close to 20,000 people around the world who basically, as volunteers, have attached their computers to the internet. They keep copies of the ledger known as the blockchain, where all the transactions are recorded. And they also compete with one another to update the next block every 10 minutes or so. And you can see that, first of all, around the world, there's a lot of redundancy. So by having upwards of 18,000 nodes, you have security simply because even in the event of warfare or nuclear attack or some other weather-related catastrophe, even if all of Western Europe, for instance, were taken off the grid, you'd still have plenty of people in the Pacific region and North America and so forth. And so the redundancy is itself a source of security. What's remarkable about the network, though, is that nobody's in charge of it. You have 18,690 people, but they are all equal. There is no central node, there's no administrator, there's nobody who can unplug the network or send out updates. The network is completely decentralized and operates through a protocol that is called consensus. And consensus essentially is achieved whenever a majority of these nodes agree that the proper codes have been entered to solve a puzzle. So it's a market-based mechanism, and it's run by an algorithm. There's really no opportunity for people to intervene to shut this down or turn it off or change it without the agreement of the nodes themselves. And for this reason, this is extremely different than the financial system that governments are familiar with. Typically, governments regulate finance from the top down. In our country, if the government were unhappy, you could freeze somebody's bank account by going to JP Morgan or having the Federal Reserve cut them off from access to the banking system. It's a top-down command system that essentially relies on the fact that there's a chain of command in the financial system and that people are accountable. Banks are accountable to the government is accountable to Congress, and so forth. In this world, you can't do any of these things. There's no way that you can freeze an account on Bitcoin. There's no way that you can block transactions from going through. And this has been extremely challenging for regulators. And it's really the reason that this system has been able to grow and to thrive, despite the fact that many governments, and I would say India's government is among the most aggressive, have tried to ban it or limit it or shut it down, tax it, whatever. You can't really do any of those things. All of the tools that are available to you in the regular financial system basically won't work when the network is so decentralized without any leadership. Why were people interested in this in the first instance? I think it's because the banking system that we have and have had really for thousands of years has not met the needs of the public very well. So what you're looking at right now are data about bank failures in the United States. And over the last 100 years or so, we've had three waves of bank failures where the system basically has collapsed and the government has had to step in and recapitalize all the banks. There was the Great Depression in the 1930s. We had something called the savings and loan crisis in the late 1980s that was a bunch of energy-related bank failures. And then the global financial crisis that began in 2009. More recently, you probably know that in 2023, just a year ago, there was another much smaller wave of bank failures in the US. But the system is very unstable. It's vulnerable to bank runs. It's expensive. It requires intervention by the central government. And the United States, of course, is one of the good countries. You know, by many measures, we've been one of the most financially successful over the last 100 years, yet our banking system has collapsed 3 times. And around the world, the system is often much worse. You know, that there are many, many countries where the banking system fails every 20 to 30 years, even in very wealthy societies like Germany, that has a reputation for being, you know, very well organized, but has had some of the most spectacular banking system failures in the history of the world. So the banking system is very unstable. It's also very high cost. This is research by a colleague of mine, Thomas Philippon, who's a French economist. He gathered data back to 1886, where he's trying to measure the cost of making a payment in the financial system as it was then configured. So if you go back to 1886, that predates the computer, the telephone, even the telegraph. So there have been vast improvements in information technology and the tools for security and so forth. But if you look at the cost for making a payment, which would have been purely a paper transaction back in the 19th century, it was essentially a 2% fee that the bank would have withheld back in 1886. And if you fast forward by 130 years, which is what this data series captures, that fee is still 2% in the year 2015, despite vast improvements in productivity. So the banking system has either not achieved any gains in productivity, or to the extent that it has, those have been internalized and returned either to the stockholders or to the managers of the bank in the form of compensation. There's an interesting comparison, in fact, if you look at the cost of trading shares of stock on the New York Stock Exchange. Through much of the 20th century, the cost of trading stock was about 1%. And this is measured as the commissions to the brokers plus 1/2 of the so-called bid-ask spread that goes to the market makers. Beginning in the early 1970s, there's a period of deregulation, and you can see that right at that point, the cost of trading stock begins to drop rather precipitously. So this is the blue area of the graph on the right. And what it shows is that by the year 2000, the cost of trading stock has dropped about 80%. And if you had forwarded this right up until the present, today it's essentially free, that the cost of trading stock is almost zero in the United States. And a great question is, why has there been so much progress in favor of the consumer in the investment market, but we've not seen anything like this in the payments function run by the banking system? Now, I think the short answer to this is that you've got a regulated oligopoly, and that the main priority of the regulators is to protect not the consumer, but to protect the banks. And I see this around the world in every country that I go to, including India, where I've had the privilege of meeting with some of your high officials of the Reserve Bank. There's enormous concern for the stability of the banks, the health of the banks, and they tend to get the privilege of charging very high fees. Sometimes are forced to lend money at the direction of the government to people who they wouldn't ordinarily lend to. But there's no use of the kind of deregulation that has been used successfully in the investment markets to the great credit and benefit of the consumers. So I think our banking system, and this is not just the US and India, but about 200 countries around the world, it's stuck very much in the 19th century, or even stuck in the model that was introduced in Roman times, where there's government deposit insurance that creates moral hazard problems and leads to a very high cost system. So the innovators behind Bitcoin decided there has to be a better way. And in 2009, on the date of January 3rd, they launched this new system, which they titled Bitcoin, a peer-to-peer electronic cash system. This was based on a so-called white paper posted by somebody using the name Satoshi Nakamoto. So the white paper was posted at the end of October in 2008, and it took just 9 weeks for some volunteers to work with Satoshi, write the code, and launch this network on January 3rd, 2009. And it's been running ever since, and is widely regarded after 15 years as the most secure and successful computer network that's ever been launched anywhere in the world. And it's achieved this, through pure decentralization. The title of this project is extremely important, where you say a peer-to-peer electronic cash system. This means that if I owe money to somebody like the electric company, if I pay them with Bitcoin, I can pay them.
Excuse me, sir.
Yes.
Excuse me, sir. Your
Yes.
voice is cracking actually. Can you improve your network?
I really cannot. I have a fiber optic network, but there's no opportunity for me to work with it.
Okay, sir, then you can continue speaking. It's okay.
Yeah, I mean, this is how I usually lecture and so forth. And I apologize if there are problems with the audio, but this is sort of the configuration that we have here. Um, the idea of a peer-to-peer network is that you don't have the middleman. So typically, if I were to pay somebody here in the US, I would send the payment instruction to my bank. The bank would debit my account, it would credit then the account of the electrical company, and it would take that 2% fee for the privilege. Peer to peer, we just bypass the middleman altogether. And this is meant to be essentially a network of digital wallets that's secured by the codes that are behind the wallet. So on the right of the slide is the front page of the Times of London newspaper from the day the network was launched, January 3rd, 2009. And Satoshi Nakamoto, whomever that is or was, took the headline from that morning's newspaper that says Chancellor on brink of second bailout for banks and coded it in as a message in the first block of the Bitcoin blockchain. So that was put there partly as a proof of life thing that you could always look back and know what the date was from the headline in the newspaper. But I think it was really done as a challenge to history. What Satoshi was communicating by taking that headline from the newspaper is that we have a new type of payment system here. And you guys in the real world are working on your second bailout of the banking system in the UK. In the UK, we won't have that problem on this system because not only is the security better, but we don't even have banks. And so if there are no banks, you'll never have to bail out the banks. In other words, what was really being launched here was banking without banks. Now, where are we after 15 years of this? I think it's important to keep in perspective that cryptocurrency is still quite small. So this is a slide that was used by one of the guest speakers in our course a couple of years ago. This is actually a former student who now works as a digital asset financial manager or portfolio manager. And the slide points out that the presence of crypto in the capital markets, which is the little red rectangle in the lower right, it was about 2.5 billion at that time, which is actually very close to what it's worth today. Vastly smaller than the government money, the size of stock markets, derivatives, and the biggest asset of all in the world economy is real estate. So these things are still hundreds of times bigger than cryptocurrency. And I think sometimes people get carried away, including governments and the news media, that it's important to remember that this is still quite small. It's a promising technology. I expect it will continue to grow, but you have to think of this as a startup that has many rough edges and is still being worked upon and improved all the time. So what do people actually use it for today in the world economy? I think by far the most important use is remittances, which is the act of sending money across international borders. So remittances are a very important function that the banking system performs. Both rich societies and developing economies rely on remittances. I sometimes work overseas. In fact, this summer I was lecturing in the Netherlands and then in Switzerland. I was paid, and then I had the problem of how to get the money home to the US to my main bank account. So I had to rely on essentially a remittance flowing through the banking system from one country to another. In developing economies, there are often very large fractions of the GDP of the country. El Salvador, in fact, is a perfect example of this, where people working abroad in countries such as the United States or maybe Japan or Europe or Singapore, they would send money back to their families at home. Remittances before cryptocurrency typically took 3 to 5 days and cost about 7%. With crypto, you can do this instantly, and the cost is very, very low. And so I think the main transactional use for Bitcoin today is actually for remittances, for people to send money across borders. And there's another cryptocurrency called Ripple that has also staked out, that's essentially the exclusive use of Ripple. But both of these have been very important challengers to what is called the SWIFT network. The SWIFT network is the global banking system that was set up back in the 1970s to provide security for remittances. And I think it's fair to say that the SWIFT network has not done very well. So under pressure from cryptocurrency, I think there's been a catalyst for the main banking system to up its game. In fact, I think the irony of a lot of the things I'm going to mention is not that crypto is going to crowd out the banking system itself, but it will force the banking system to improve, to try new technologies. And the obvious thing that they want to be looking at for remittances is a blockchain-based transfer system that is very similar to what Bitcoin and Ripple and other currencies are also using. So I think the growth of remittances, both within rich economies and developing economies, has been very impressive and is almost certainly going to continue. A second use, and we saw this with the El Salvador example, is that cryptocurrency is an alternative to fiat currency, the government currency. El Salvador has gone further than any other country in actually making it an official legal tender, but there are many other societies, and I think Venezuela is the one that comes to mind for most people, where essentially hyperinflation has hit the local currency and made it almost worthless. And so people have looked to crypto as an alternative that essentially would compete in the shadows and offer another way to not only send money from one person to another, but also to just make regular retail payments. So we do see a lot of activity in countries such as Zimbabwe, Argentina. There is a lot of use of crypto in developing countries such as Vietnam, Nigeria, and many, many others. But essentially, it's there to compete and provide something of a reality check for the central banks that are issuing fiat currency. And I think even if crypto doesn't become the official currency of these societies, the fact that it's there as a source of competition is very, very important because it forces governments to be more accountable and to do a better job. Finally, probably the most interesting application of digital currency is what's often called DeFi, or decentralized finance. This is really the domain of Ethereum, and many of you probably know that Ethereum is the second biggest crypto. It's about 40% as big as Bitcoin right now. And Ethereum allows you to execute things called smart contracts, where you can essentially program digital coins to move if and only if certain conditions are met. And if you put these smart contracts together in a organized and clever way, you can have entire platforms, sometimes called DAOs, or decentralized autonomous organizations. And these DAOs can allow you to trade assets, to borrow money, to create derivatives, to enter into all the types of financial transactions that you might do at a regular bank in the traditional economy. What we're beginning to see, and I think this is extremely interesting, is that these DeFi platforms are hosting tokenized assets such as US Treasury bonds, where somebody takes a bunch of assets from the real economy, puts them safely into escrow, and then issues digital tokens that are surrogates or replications of the real world assets and allows people to trade them on these decentralized platforms. I think DeFi is very exciting technology, and it's likely to be incorporated in very short order by the big banks. In fact, there are very high profile projects already going on in the US at places like JP Morgan, Goldman Sachs, some of the biggest brands in finance. And again, DeFi may not really take the market share so much as becoming a catalyst for banks to reconsider the ways that they keep their order books, provide security for their assets, and so forth. Now, why does all this work? Why are people prepared to trust this? The short answer to this, and the answer, in fact, is a very complicated one, but you have people all around the world using bunkers of computers. These look a lot like the modern data centers that you might see in a regular bank, but these are built in special locations where there's access to cheap energy. And these computers work around the clock, solving the cryptographic puzzles that are essential to Bitcoin and most of the other cryptos. Even cryptos like Ethereum that have moved to a different consensus system, which is called proof of stake, still rely on cryptography to provide a lot of the security for the addresses to the wallets and so forth. But it's because the number of computers involved in doing this work is so vast, and they are competing head to head with each other on a regular cycle to try to solve problems faster than the next person. It's the competition itself and the very impressive amount of resources that have been invested in that competition that provides for the security. So what these miners do is essentially write new blocks onto the Bitcoin blockchain when they're able to solve a puzzle that comes up every 10 minutes and can only be solved by brute force, trial and error, repetitive calculations. So this system is called proof of work. It's a very expensive system. It uses a lot of energy. And what's remarkable about it is that, like the rest of crypto, it's totally decentralized. There's nobody in charge of this, nobody giving commands to open a data center, turn the data center on or off, and so forth. These are simply entrepreneurs responding to incentives who have popped up all around the world and essentially decided to do the work that keeps the network secure, because there are rewards built into the system of new coins for those people who do this successfully. So it's interesting to look at what this actually costs. And you'll remember about 20 minutes ago, I showed you the slide from Philippon that shows that the cost of a regular transaction in the banking system has been about 2%, at least for 130 years, as far back as we can measure, and probably much further back than that. If we look at the cost of transactions on Bitcoin, it's been dropping very steadily to the point that it's about 0.75% if you look at recent numbers. In other words, it's about 2/3 cheaper than a transaction in the regular banking system. And what's also interesting is that the value of the Bitcoin transaction is not relevant to the cost of the transaction. The cost of sending $1 million worth of Bitcoin is really the same as sending $10 worth of Bitcoin, because the cost is based on the amount of computer memory rather than the value of the coins that are being sent. So for people willing or needing to make very large cross-border payments, this system is very, very attractive. If I needed to send 10 million or even $100 million to somebody abroad, it's basically free to do that over Bitcoin, 2% or maybe more to do that through the regular banking system. Now, I want to take a few minutes to talk about something called a stable coin, which has begun to grow in importance and has been attempted by social media companies with success in China, but at this point, not so much in other countries. And there's a very good reading on this that I would recommend, where the main author is a German professor, Markus Brunemeyer. Some of you may know Marcus because he has a podcast called The Marcus Academy, where he gives very, very well-written, trenchant explanations of things going on in the world financial system. Marcus is also the president of the American Finance Association right now and is a professor at Princeton University. So this essay, written 5 years ago, begins with a simple observation that money historically has 3 roles to play in the economy. It's a unit of account, a medium of exchange, and a store of value. And I think anybody who's taken a first-year economics course would have encountered this definition sometime in the first week or two of lectures. Now, if you look at digital currencies, they don't necessarily try to do all 3 of these. In the language that's used in this essay, digital currency unbundle the 3 functions of money and will attempt to do maybe only 1 or 2 of these things. And the stable coin in particular is very, very important. What a stable coin typically is a synthetic version of the US dollar. So somebody issues a coin, says this is worth $1, and if you want to trade it, what you're doing is using the US dollar itself as the unit of account. So a stable coin is really trying to do only 2 of the 3 things. It's not trying to become a unit of account. It's simply trying to be a medium of exchange and a store of value. The stability sometimes is an issue, but the medium of exchange works because the stable coins are based on blockchains. And if you want to trade one blockchain asset for another, say trade Bitcoin for Ether or for Ripple, you can do that very easily by using the stable coin as sort of the intermediate step in that trade. So stablecoins have grown very, very quickly, and there's really three groups of people who issued them. Probably the most interesting to date are the private entrepreneurs. And there are two stablecoins in particular that really dominate the market right now. One is called Tether, which is known by the acronym USDT, and the other is issued by a company called Circle in the US, and their stablecoin is called USDC. Both of these are supposed to be worth exactly $1 and are available to be traded on blockchains by anyone who has the need for a token to exchange for some other asset that would work as a medium of exchange and as a store of value. Now, who are the other two groups? The second group are social media companies. And in China in particular, there are two payment systems, one run by Ant Financial, which used to be part of Alibaba. That system is called Alipay. And the second is run by a media company called Tencent. The system is called WeChat Pay. But between them, Alipay and WeChat Pay have come to dominate the retail payments business in China. These are extremely important platforms that have taken enormous market share from the regular banks in China. Now, what about the rest of the world? You've had an attempt by Facebook to launch a stablecoin that was going to be known as Libra. This was about 4 or 5 years ago. It didn't work out. The project was renamed Diem. It's now been shut down and liquidated. I think, though, that Facebook made a critical error because they tried to create their own monetary unit, the Libra. I think if they had issued different versions of the Libra, like the Libra dollar, the Libra euro, the Libra rupee, and so forth, they might have had much more adoption. But I think what Alipay and WeChat Pay did and what Tether and others have done is not try to disrupt the unit of account, to just take as given that the government will set that with the fiat currency, but to do the other two things, the medium of exchange function and the store of value, to do those better than the regular financial system. And I think, at least in the case of China, this has worked extremely well. Now, the third group that is interested in issuing stablecoins are central banks themselves. And there's something called CBDC, or central bank digital currency, where the government might tokenize the money and retire the paper bills and the metallic coins that everybody's used to dealing with, and simply make all of the money electronic on a big central ledger, probably a ledger run by the central bank itself. So China has begun to introduce a version of the yuan, the national currency. Up to now, they've not been particularly successful because it's much more difficult to use the Chinese CBDC than to use Alipay or WeChat Pay. But you do have some other countries, including a consortium of countries in the Caribbean that have a CBDC known as the Sand Dollar. Nigeria has one. And most other central banks, including India's, are looking at the development of a CBDC. I think in many cases, the motivation is to make sure that China doesn't get too far ahead, that if China launches one and is the second biggest economy in the world, other countries had better have their own projects, or the Chinese money could rapidly take over the whole payments business of the world. I think at the moment, there's not much to worry about because the Chinese CBDC really doesn't work very well. And as it's run into problems, I think other countries have slowed down their projects as well. But I think where we're going to end up in 20 or 30 years is, in fact, that governments will be issuing stable coins under this framework of a central bank digital currency. And this will be extremely ironic because Satoshi's technology would have then essentially taken over the financial system and provided the platform, for everybody to transact on, even if it's overseen by governments. So how have the stablecoins actually grown and performed? This is a logarithmic scale, and it shows that Tether, which is the red series, has always been the largest stablecoin. Others have kind of come and gone. The green series shows the Circle stablecoin, the USDC, which has actually been shrinking a little bit over the last year or two as Tether has continued to grow. But the one that's particularly interesting is the purple series, and I'm pointing at it with my cursor right now, the so-called Terra USD. The Terra stablecoin collapsed in the year 2022. and a very spectacular catastrophe. Terra was issued by a company in Korea that essentially used an algorithm based on another cryptocurrency called Luna to keep the Terra coin stable. To make a long story short, the system didn't work very well. It was organized more or less like a Ponzi scheme. And when Luna began to run into trouble, people began to unload their Terra, which drove the price of Luna down even further. And you had a very rapid collapse of the Terra USD stablecoin, which at the time was the third largest and was growing very, very quickly. So I think there's good reasons that that project collapsed, and it's remarkable that it ever got off the ground in the first case. But really, this is a cautionary tale that all of the other stablecoins need to look at Terra USD and make sure that this doesn't happen to them. And essentially, the concern for people who hold these instruments and transact in them has to be, how can we be sure that this is not the next Terra USD? You know, how can we be sure that Tether won't collapse in the way that Terra did? And I think the answer to that is very complicated. I have my own concerns about all these, but at least so far, this whole area has continued to grow. It's now worth in excess of $200 billion. But again, the point can't be made often enough that this is still pretty small. Here's Alipay and WeChat Pay. And this is a photo that I took 5 years ago when I was out Christmas shopping at Saks Fifth Avenue with my wife. So we were literally at the main store on Fifth Avenue in New York, and we were in some boutique for luxury goods that was going to be a gift for my wife's Christmas present. And when we got to the register, they invited us to pay in cash or in American Express, MasterCard, Visa, whatever we wanted to use. But we were also given the option to pay with Chinese social media money. And I thought that this was pretty impressive that these Chinese commercial companies had penetrated Western capital to the point that when you get to the cash register at Saks Fifth Avenue in New York, they'll accept it. You know, they invite you to pay. I think the target market is not people like me who live and work in the United States. It's really Chinese tourists who are overseas and want to use their own mobile media money to shop for luxury goods abroad. The COVID pandemic, which very abruptly brought an end to travel and to cross-border payments, to a large extent, that slowed down the growth of this. But I think this example shows very well the ambition of the people behind this, which is to take this around the world, to have this be not a system just for China, but a system that will essentially be universally available to consumers everywhere. Now, coming back to the essay by Brunemeyer and co-authors, they latch on to the example of WeChat Pay and Alipay, and they say that there's an interesting transition underway. On the left is a very simple system where a bank takes deposits and then lends out those deposits to people who need to buy a house, to buy a car, to pay their university tuition. We have student loans for that in the United States and so forth. But this is what's called a bank-centric model, where the capital comes from deposits, and this is the model that's been used around the world for hundreds and hundreds of years. What they argue in the essay writing insurance, making loans, circulating derivatives, all the things that we ask financial organizations to do in the real economy. So I'm going to stop at this point and leave a little bit of time for questions. But I think, this is sort of what we've arrived at, is a system where you essentially have new technology with digital assets that are available for all of the traditional roles that banks and other providers have played in the financial system. But the security, the transparency, and especially the decentralization are completely new. And there's both challenges and opportunities that are going to be very interesting, I think, even more for your generation and your children's generation in the years ahead. Okay, so let me wrap up there. And Sumya, I'll leave it up to you to figure out how to channel the questions to me.
Yeah, we'll start with the questions right now.
Okay.
You're not audible.
Hello, Professor. Am I audible?
Yes, I can hear you.
I actually had a question related to the decentralization of these digital currencies. Since these currencies are not regulated, they're not monitored, they cannot be controlled, won't it lead to the rise of shadow economies, which will eventually, and if we use these currencies in a wider manner, won't this eventually result in far more illicit activities like money laundering, etc.?
Yeah, I think there's really two parts to this question. The first part is that governments will definitely lose control. And this makes governments very uncomfortable. Frankly, some people are probably pleased about this because they don't like the way the government plays an intrusive role in invading the privacy and controlling the economy and so forth. But yeah, the implication is very clear that the sponsors of the currencies will take control of functions that governments have historically regarded as their own domain. And because it's so decentralized, there's no real way to stop this. So one of the points that Marcus makes in his essay is that in the future, you may view yourself not as a citizen of India or the United States, but as a citizen of Google or a citizen of Facebook, really depending on whose media money you choose to use. I think in the case of China, it's very obvious that people trust Jack Ma and Alibaba way more than they trust the dictatorial government, the Communist Party, which is why those platforms have grown so much. And I think they've made people's lives much better off. So yes, you'll lose control, but that's not necessarily a bad thing. In fact, it might be a very good thing for many economies and countries around the world. Now, will there be more illicit activity? I'm not so sure, because there's a lot of illicit activity, lots and lots of it, in the regular banking system. All kinds of money laundering goes on. And the cash economies with these suitcases of $100 bills, people evade taxes, they engage in smuggling and so forth. Digital currency is much more transparent. And even if governments don't control it, they can monitor it. And we've seen that governments in the US have used information from Bitcoin to take down rings of human trafficking, child pornography, to cut off financing to terrorism and so forth. I'm actually much more optimistic that you'll have a lot less illicit activity once crypto is more and more widely used, simply because you can monitor and trace it much better than you can the money in the regular financial system. Time will tell, but there's a lot of research that's been published on this, and it suggests that the security and the ability to combat different financial crimes is actually much stronger in the crypto economy than it is in the traditional economy.
Hello, Professor. Thank you for this wonderful session so far. So my question was on the algorithmic stable coins. So like what type of algorithms do these stable coins use? And the second one is like why did certain algorithmic stable coins like Terra USD go down? And third is like with the rise of AI and deep learning, machine learning, can we think of a better algorithm to make sure that we can improve the quality of algorithmic stable coins?
Yeah, this is a very interesting area. It's one that I've been doing research in myself. Stablecoins basically have two approaches. One is the algorithm that essentially will buy and sell stablecoins to try to keep the price stable. This is the same thing that central banks do to try to manipulate the price of their own currencies. The other way you can run a stablecoin is with what's called a redemption or a reserve model, where essentially you set up an escrow account. So Tether and Circle both use the redemption model. And essentially for every Tether in circulation, there's an account which has a deposit of real money in it. And if you wish, you can redeem one Tether for $1 from the reserve account. So I think the data are very clear that the algorithmic stable coins are not as stable as the reserve or the redemption stable coins. But I do think that the algorithms will probably improve for the reasons that you said, that crypto has no barriers to entry. The wonderful thing is that the innovation continues week by week, month by month. People are always developing better and better coins that acknowledge and then try to improve on the problems that have already been discovered with the ones that are already circulating. So I have no doubt that stablecoins will benefit from more innovation. I'm not sure that the algorithmic model will ever prove itself to be better than the redemption model, but I wouldn't rule it out. I think it's really in the hands of the next generation of entrepreneurs. And I know that there's a very large number of smart people working on these problems, and not just with stable coins, but with smart contracts, with the instruments that are similar to Ethereum and so forth. There's new coins and tokens being launched all the time. And I think one of these will eventually overtake Tether in the stablecoins market, will overtake Ethereum in the digital finance platforms market, and so forth. But we have to wait and see, exactly what comes to market and, how it does competing head to head.
Hello, Professor.
Hello.
I had a question regarding incentivization of the investments in cryptocurrency as compared to say stock markets for an ordinary person. So like we all know, like the crypto has been in talk for huge fluctuations in its value. Whereas if an ordinary person wants to invest in some stock market, right? So the people can judge some stock by the work the company is doing. Whereas what are the factors on which an ordinary person can judge some cryptocurrency to invest in it and stay out of the risk of huge fluctuations that it sees?
I would be very, very careful. I get asked all the time, how much Bitcoin, how much crypto do you own? And the answer is zero. I've never invested in this at all because, like you said, it's crazy risky. I don't know what the intrinsic value is of cryptocurrency. The price of Bitcoin lately has been $50,000 or $60,000 a coin, but I don't know why. And what I do know is that it fluctuates a lot. It goes up, it goes down. And I don't think as an investor that you're being fairly compensated for that risk. So my advice to anybody would be, don't own this. It wasn't designed to be a speculative investment. And the 15 years of data that we have show that it's been very, very risky. Now, having said that, the classic investment strategy that any professor will tell you about is to index your money, which is essentially to be a passive investor and own a very broad-based fund that invests in every stock on the stock exchange. If you do that, you have to recognize that some of those companies are deeply involved in crypto. NVIDIA would be the first company that comes to mind. NVIDIA's graphics cards are heavily used in crypto mining. Big banks like JP Morgan have their own private blockchains and are heavily invested in the growth of crypto. Intel, which makes microchips used in crypto hardware. All of these companies have become more valuable because they participate in the crypto industry. And so if you're an indexed investor, indirectly, you will be invested in crypto, whether you realize it or not. If crypto represents 1 or 2% of the world economy today, which is probably a rough guess, you should probably have 1 to 2% of your wealth invested in it, just like any passive investor rule of thumb would recommend. But you can get that just by, holding the regular stocks and bonds on investment markets, because those companies themselves already do participate and benefit from the crypto markets. So no one should make the mistake of today's talk being a recommendation that people should invest in crypto. I don't own any. I don't think anybody should own it. Having said that, I've got 4 kids, and 2 of my 4 kids own it, not because I told them to, but because they're young and have certain attitudes toward risk and so forth. But I think that this is not for the faint of heart. You shouldn't put any money into crypto that you're not prepared to lose, and lose very quickly if things go bad.
Professor, in one of your last slides, you talked about the 2 different ways the banking works. For example, you took the example of the bank system, and then you took the example of the payment system, if I'm not mistaken.
Right.
The banking system is, because it's controlled by the government, it's regulated by the government. For example, the Reserve Bank of India uses measures like the credit reserve ratio and statutory liquid reserve ratio to monitor these banks and regulate the banks, so that at the end of the day, the economy is more stable. The banking system becomes more stable. But these privately owned ventures, for example, you took the example of Alipay, and you said that the citizens of China might trust Jack Ma more than they trust the government of China. But in case of stable, or at least semi-decently stable economies, why wouldn't the average human being prefer to trust the banking system more than these privately owned ventures?
The answer to your question is very simple. I showed you that slide that the US banking system has collapsed 3 times in the last 100 years. And we're a good country. Governments don't do a very good job of regulating the banks. I mean, I would invite all of you to go home after the talk and think, how good a job does the Reserve Bank of India really do? And I think it's almost every country in the world, the answer is really pretty dismal. Through most of world history, banking was essentially a private industry where banks competed on reputation. And customers would refuse to deal with banks that didn't run themselves responsibly. Governments only got involved in this in the 20th century. The track record is not very good. We wouldn't have had a financial crisis 15 years ago if governments hadn't totally screwed up the oversight and monitoring of the banking system. I think the technology is changing much faster than governments understand or are prepared to deal with. And if you're willing to put your trust in the government ministries that have failed so badly, I wish you good luck, but I think you're being very naive about what skills they truly have. And I have many personal friends who work in the Reserve Bank of India and who work in the Federal Reserve in the United States. They're good people. They're doing the best job that they can. But these organizations have basically failed at their mission over and over and over again. And I think what digital currency offers on a decentralized business basis is a very different model that, to me, is much more likely to be successful at issuing money in a stable way and avoiding hyperinflation and panics and bank runs and all the other problems that we've seen over and over and over again in the regular banking system. It's very frustrating to people. And if you live in a country like Venezuela or Zimbabwe, Argentina, you would know exactly what this is about, because you have to live it every day.
Okay, thank you so much for this session. We cannot thank you enough for your time, your valuable time, and we got to learn a lot of things from you this time. Looking forward to connect with you in future. Thank you so much for the session.
Okay, thank you all very much.
Yeah. Thank you so much.
Okay. I wish you all a good evening. Bye-bye.
Yeah. A good morning to you, sir.
Thank you. Bye-bye.